If sellers misrepresent the financials or the culture of their company, that can be detrimental in a transition of ownership. If you're buying a company with a toxic culture, I don't think new ownership is going to help that. So if they received a PPP loan, don't include that in the revenue and profits, or an idle loan, or employee retention tax credit. Always back those out. If they've sold 7 trucks in a year and they're showing that as other income, that's probably not, going to be reoccurring income. And really, customer concentration, work mix, I can't harp on that enough, is really important for us. Born and raised in Eastern North Carolina, went to school about an hour and a half from where I grew up at the University of North Carolina, Wilmington, studied finance there. And Wilmington's somewhat of a small town, I guess you could say, compared to like Charlotte or Raleigh. I think our populations are about like 90,000. So not too terribly small, but not too large. And, each week throughout the year, in our business school, is called Business Week. So a lot of different, local companies come and present on kind of what their companies do, potential career paths. And Live Oak Bank was always like a sellout. So attending that, listened to our current CEO speak back in like 2014. And I was like, man, sounds like a great place to work. A lot of opportunity for growth. I really like, what they do for small business owners. And applied out of college. Wasn't able to get my foot in the door, right after graduating. So went to work for a smaller regional bank called BB&T, which actually merged with SunTrust which is now Truist. So I was a personal banker there, and then joined Live Oak in 2017, and have had about 4 different positions since joining, and have been on the lending side of the bank since 2018. And specifically in the HVAC and plumbing space since early 2020.
Oh, nice. Okay. And how many divisions are there like this, like yours, HVAC and electrical?
Roughly 40. But we also have a general lending team where we can, really finance any type of business as long as it hits certain, targets for us.
Got it. So your division is HVAC, electrical, and then what else? You do plumbing also?
And plumbing, yep. And we've looked at, a few like remediation, restoration type businesses. Really think like stable, reoccurring revenue, essential business, businesses that aren't tied to new construction or new build, that don't really have a customer concentration risk. So, I get a lot of questions, does landscaping fall in that territory? Yeah. Unfortunately not. Or, we have looked at some roofing companies, but, primarily I would say 90% is HVAC. And obviously a lot of HVAC companies have plumbing tied to the business as well. And then also electrical.
So why not landscaping and roofing if they're not tied to new construction?
Yeah. So again, we have looked at a few roofing companies, and I know our company has done a lot of roofing companies. I think landscaping has been tough for us to do, just with barriers to entry, and then overhead and profit margins associated with that industry. But to be, completely transparent, I can't speak, into too much detail just because I haven't really worked on those deals. But just, from afar, I've just kind of heard, there's a lot of competition, and margins are typically a little bit tighter on those businesses.
Got it. Okay. So for like the last 4 years, you've been focused and specialized in HVAC, plumbing, and electrical.
Yep. Yes, sir.
Of those categories, which one is your favorite?
So that's a good question. I mean, I think really it comes down to the operator versus the business. I think that's really what makes the difference. I will say we do look at a lot more HVAC and plumbing companies than just standalone electrical. I think just with the nature of electrical companies, there's a lot more electrical companies that tie into new construction and remodel work, which, we could somewhat view as discretionary spending versus, man, my AC's out, it's 99 degrees in, Florida right now, I need to get this replaced. But that being said, I've also done an expansion loan for a $12 million electrical contractor that solely did electrical, who was operating at a 20% margin. So there are really, really good electrical service, repair and change out based companies. But just due to the nature of the work mix, we typically just see more HVAC, plumbing, and also like those HVAC and plumbing companies will have an electrical division too, for additional cross sell opportunities. So, but I'd say primarily HVAC, plumbing.
Got it. Okay. I know you had some slides, so I'll let you share them with us and then go through them. And then anyone, if you guys have any questions, please feel free to ask at any time.
Yeah, I second that, Jay. Yeah, guys, please feel free to interrupt, raise a hand, ask a question. Be glad to try to help answer any on the fly. So let's see.
Dylan, do you do any pest control companies?
I believe we have looked at a few pest control companies as well. Yes, sir. All right. Everybody see the screen?
Yeah, I see it.
Perfect. Yeah, so dive into a little bit about Live Oak Bank. I'm sure a lot of you on the call probably have never heard of us, but we're a company, again, headquartered in Wilmington, North Carolina, founded in 2008, which was a very interesting time to start a bank. But we started back in 2008, solely making SBA expansion loans to veterinarian offices. And, we did that really well. And over the years, we continued to grow in that industry and started scratching our heads. And we're like, man, there's so many other, strong, stable, profitable businesses in other industries that, we should look at. So fast forward to today, we're in like 40-ish different industries that we specialize in. Making small business and middle market, loans to. But with us being, headquartered in Wilmington, North Carolina, we do have the ability to service every state. So we have a national lending footprint, roughly about $11 billion in total assets. We went public in 2015. Been the number one SBA lender year over year in terms of dollar volume in the country since 2017. And we're a truly like innovative bank. We're constantly brainstorming and getting feedback from customers on, what better ways we can serve small business owners, whether that's from a lending or deposit standpoint. Two recent examples, we just launched a new working capital loan product for SBA loans that allow us to go down to $10,000 in funding. Our previous minimum was $150,000. So that opens the door for financing for a ton of small business owners that have probably been underserved from a ton of other financial institutions in the past. And then another example that, I probably don't talk about enough is our business checking and savings account solutions. I may be a little biased, but I think we do have the best customer service in banking. With pretty much every aspect of being a Live Oak Bank customer, you have direct access to an employee's direct line and or cell phone number, which is a little different. If I've had to try to contact Bank of America recently with a question on my credit card, and I called an 800 number and had to go through a series of automations, and after about 15 minutes, they just texted me a link to live chat with a bot, I would assume, and just really hard to get somebody on the phone. So I think that's really one thing that sets us apart is our customer service and our industry expertise, which kind of funnels into this next slide. When working with contractors specifically in one industry, I think it really gives us a leg up in terms of speed and understanding and guidance throughout the process. It's oftentimes
I don't think your slides are moving.
Oh, really?
Yeah.
Let's see. What slide can you see?
The first one.
Introduction to Live Oak Bank.
Yeah.
Let's try this.
On the middle market loans, how large do you guys go?
I mean, they do. Again, I can't probably speak as intelligently as lender on that team, but I think we have the ability to do like 50 million plus in funding. I don't think it's something we probably don't do $50 million loans every day, but $10-20 million loan probably isn't super uncommon for folks on that team.
Got it. Okay. And
All right,
on the SBA, do you do the peer pursue type loans?
Yes. Yep.
Okay.
I'm doing a SBA loan right now for like 6.5 million, where we're doing a SBA loan, pari passu, and conventional line of credit.
Okay.
All right, let me try this again. Are slides moving now?
I see the second one. Yeah.
What about that one? Is it still moving or?
No.
Man. Let me try this one more time. If not, I'll just kind of go off. Yeah, will only let me show a certain window when I click on that window.
I'd say do full screen. It's a lot easier.
Yeah, I tried doing full screen. It doesn't give me the ability for some reason. Yeah, entire screen. There's the share option. Oh, there we go. All right, let's try this now. Are they moving now?
Yeah, it's moving now.
All right, appreciate it, guys. So yeah, I'm diving into industry-focused approach. When we're working with contractors, most of the time we're the first bank they talk to when discussing like an acquisition or a real estate loan, but sometimes we're not. Maybe they go to their local bank, and oftentimes local banks just they don't lend in this industry, so they're not really familiar with a contractor that does all service repair and change out work versus a contractor that does new construction. A lot of banks just view this as a blue collar industry that's really tied to new construction that does not have sophisticated business owners. But with us specializing in the industry, we know what questions to ask. We know what to look for in the financials. We know what products best suit that particular business owner for growth and or to improve cash flow. So we really understand the industry. We really understand their business. I spend every single day looking at tax returns and profit and loss statements and balance sheets for businesses in this industry. I would say we really specialize in two different buckets: growth and transition financing, which we'll kind of dig into in an additional slide. And then, another thing that I think makes us unique is we actually visit our customers in person. So while we may be located, many states away, we do provide, top-notch customer service and actually get out and visit customers in person. I was at a business in Michigan last week, and GM's buying out an owner, and or the current owner, and the current owner was like, I've been banking at my bank that's 2 miles down the road for 25 years, and they've never stepped foot in my business. So they thought it was really cool that I went all the way to Michigan just to visit with them for an hour inside their business and really learn how we can help with the loan process. But how are business owners using Live Oak Bank? And I think half of the business, half of the customers that we work with are existing business owners. The other half are folks acquiring their first business. But business owners or first-time owners are using us primarily for acquisition. So if you're an existing business owner and you want to expand and get into a new area, or there's a local competitor that you think would be a good opportunity to add employees, phone number, maintenance agreements, so on and so forth. That's a common product for us. Commercial real estate. I will say commercial real estate's probably cooled off in the last 12 months. From 2020 to 2021, just due to the interest rate environment. A lot of folks are trying to see if they can extend that lease 1 or 2 more years at the current rate to just kind of see what the market's going to do. But in terms of rate offerings, we're as competitive as anybody will be in the SBA space. And then, a lot of working capital financing. So if you're an existing owner and you want to increase your marketing or advertising budget, or there's some good training opportunity for your folks that you don't want to spend cash on, or you want to hire a new salesperson, get a new, another truck on the road, van on the road. Those are all very majority of common ways that existing business owners use us. And then also on transition planning. So an existing employee trying to figure out what options they have to exit their business. And those are typically internal buyouts, owner selling to key employee, family member, neighboring company, or family member. But also we work with a ton of first-time buyers or first-time business owners. When kind of working through those specific scenarios, we really have to dive into the business and transition plan of that business owner that's going to acquire that new company. And, really the kicker there is licensing, which can differ from state to state. There are certain states that don't have any licensing requirements at the state level, and there are some states, that it may differ on a municipal standpoint. So having a licensing plan in place is very important for us if you're a first-time buyer. I can dive into further detail if you guys would like there. If anybody has any questions.
Yeah, that's always something that we see with HVAC and electrical.
So if you're a first-time buyer, typically, we don't want you relying on the seller of the business and the seller's license. For the SBA, sellers are allowed to stay in the business for a maximum of 12 months, and then they have to fully exit. But now SBA also allows for partial buy-ins where you could buy like 95% of the company and the seller retain 5% and provide the license in that, regards, which would be okay with us. But, essentially we want to see the license holder of the business be tied to the long-term success of the business, whether that's a small, equity stake in the company, could be as little as 2 to 3%. Or, you have, say the GM and lead salesman of the company have, can qualify the business in terms of licensing that you're looking to buy, but you don't want to give out any equity. Maybe you could have an employment agreement signed, which can also be tricky because a lot of times, employees don't know that they're underselling. So it can be kind of tricky waters to navigate. But, ideal scenario, we have our owner operator that's going to be our personal guarantor, be the license holder. If that is not achievable, maybe having a partner that you can bring in to give, minority equity to license the company, whether that's the seller or, somebody that you're able to source to help operate the business. And then third option is maybe having, a key employee tied to a long-term employment agreement. But ultimately, at the end of the day, we want to see our owner operators, our personal guarantors that signed off on our, debt financing to be the license holder of the company.
Got it.
Hey, Dylan, it's Corey. What's the rationale behind that? What's the rationale behind that? I mean, obviously there's some risk associated with losing the license, but it's been my experience tradesmen make shitty business owners.
Yeah, I agree. I mean, I think, the main thing is just making sure that the business from a legal standpoint is able to operate and complete jobs. Not to say that, somebody that maybe has a legal or, financial services background will not be as good of an operator as, a guy that, has been, probably behind the ball for the last 20 years or behind the curve for the past 20 years. But essentially, we want to make sure from a legal standpoint that the business is following all state and local laws. So, there can't be any pending litigation or, future litigation if something were to go wrong. I think licensing in general is something that SBA has really cracked down on, just because this specific industry has, gained attraction from a lot of outside non-industry buyers over the past few years. So it's really been a point of emphasis from the SBA to say, hey, we're really going to dig into, licensing and transition plans, and all of these loans in situation of an audit, but also just, from an operational standpoint, we want to make sure the business, is following, all state and local requirements when, putting in new units or servicing or doing repairs.
Yeah, thanks. I was just curious as to what bank thought about that, because my managers are signed into long-term employment agreements and are on my operating agreement as managers, but they're not owners, and they I obviously have no licenses, but prefer it that way. But so I was just kind of curious.
Yeah, and it sounds like they're tied to the long-term success of the business. I mean, if they're under employment agreements, then that's something we can probably get comfortable with as well. Awesome. So what do we look for in a deal, whether it's the business profile or the individual profile? So we'll start on the business side. Ideally at or exceeding $1 million in annual revenue. I think what's really important for us is, the work mix, which we've kind of touched on a little bit. We really like service, repair, and change out, and minimal exposure to new construction. I would say a nice benchmark for us is, 25% or less of total revenue coming from new construction, whether that's residential or commercial. And also customer concentration can kind of tie into that as well. And we are cash flow based lenders. So we lend on the ability for the business to repay the debt. So we, typically want to make sure these businesses are cash flow positive. From an individual profile, personal credit score of 680 or above, no prior bankruptcies, and we prefer industry experience. If you don't have that, again, we do about half of our deals. Folks don't have that direct industry experience. So, there are ways to manage around that risk. And we've done a lot of, really successful, transactions from folks coming outside of the industry to help, modernize and scale these businesses. So that's where kind of the transition plan and business plan can be very important for somebody that's, quote unquote, non-industry. The loan review process, kind of how, if you are interested in acquiring one of these businesses, what does that look like? So, I think, the first step is to connect with me, which I'll share my contact info at the end of this presentation. But, from a business review, we run a cash flow analysis, take a look at the work mix, customer concentration, transition plan. So we want to know, what jobs and responsibilities does that current owner or the seller currently have in the business? Are they absentee? Are they out running calls? Because I think that can kind of pose, two different, scenarios as a new owner. And then on the personal side, personal credit pool, we do look at resume, and then we'll take a look at a personal financial statement to see what kind of liquidity and collateral you have. The beauty of the SBA loan product is, you don't have to be super rich and have tons of equity and outside collateral to get approved for these loans. However, when you do have, liquidity and collateral, that, can be considered in these deals. So
for the cash flow analysis, what do you rely on? What, aside from P&Ls and taxes, tax filings, what else do you use to do that?
Yeah, I mean, we'll look at, accounts payable, accounts receivable reports to make sure that, the business is paying their suppliers on time and also getting paid by their customers on time. But really what we look at, the specific metric, I guess we look at is called debt service coverage, which is essentially, the net operating or free cash flow of the business, net operating income, free cash flow, SDE, EBITDA. There's tons of different, terms for it. But essentially the cash that the business generates divided by the debt payments on an annual basis. And then we have to account for, if it's a first-time buyer, a salary for the new owner to draw. But really that's it. I mean, it's, which you'll see in our next slide, but previous 3 years of business tax returns, and then profit and loss statement, balance sheet, accounts receivable, accounts payable reports.
Can you speak to that salary, aspect, because that can affect the DSCR, and then especially if there are two partners in a business.
Yeah, most certainly. So for an existing business owner, if you're acquiring a second location, we will assume you probably won't need to draw an additional salary out of that business to cover your personal need. But really how we look at, it's called officer's compensation, is we'll look at, your historical salary that you've taken from, in terms of like W-2, whether that's from a previous job or from your existing business. And we'll compare that to your personal debt obligations. So we look at your personal credit report, and typically how we calculate that is we look at monthly payments, and then we multiply that by 12 to annualize it, and then multiply that by 2 to account for additional living expenses. And we kind of compare that figure to the historical salary that you've taken from the business to come up with what we determine you'll need to draw from the business in terms of a new salary.
Oh, interesting. So it's specific to the individual.
Yes. Yeah. We don't just say, hey, we think every business owner in the heating and air industry needs $100,000 to live comfortably. I think it can differ a lot, also, where you live. I think living expenses are a lot higher in San Francisco than they are in Leland, North Carolina. So, it's really on a individual basis.
Have you ever had any times where that was an issue in terms of like getting the debt service in the right place and making the deal done?
Yeah, most certainly. I mean, it's not necessarily, somebody's fault, but, for example, California, typically mortgage and RIP payments are a lot higher than they are in other places of the country. So if you're looking to acquire a smaller business, but you have a $6,000 monthly mortgage payment, and you're buying, let's say, $1 million business where the old owner only took like 50,000 out of the business or 60,000 out of the business to support, their personal living expenses each year, then that can kind of throw off debt service coverage. But, that being said, we also use a lot of common sense and good judgment, I think. So it really just depends on the deal, the size of the business. I think with larger businesses that produce more income, the personal need is not much of an issue. But if you got two owners looking to buy $1 million business where there's only like $100,000 of free cash flow, and you got to pay debt payments with that, there's not a lot of meat on the bone, after those loan payments are made. So I think size of the business and what personal need you have. Maybe you have some outside income or spousal income that can help offset that draw need or that officer's compensation need, which we can also account for. So there's tons of different ways. We kind of analyze that, and we just try to brainstorm and come up with a common sense decision based on size of the business, and historical salary and what personal debt looks like.
Makes sense. Chris, you have a question?
Yes, I had a question on, you go off the W-2 of a prior business owner. Do you also include their distributions?
We do not include distributions because those can be, we kind of view those as discretionary, depending on how the business is doing. We typically just look at W-2.
Okay.
Interesting.
But if the owner only takes distributions and doesn't have a W-2 salary, then we kind of can look at it that way as well. So I've probably closed like 45 acquisition loans in the last 5 years, and I don't think one of them has been, exactly the same as the previous one. So every deal's different. Everybody's got typically a different financial situation, and there's nuances to every deal. And I think that's why, we're so good at getting these approved and closed. It's just the sheer volume of this specific industry and deals we've worked through. We kind of know how to work through any obstacles or challenges that may present themselves.
Within those categories of businesses that you have, which one gets repaid the fastest?
Which one gets repaid the fastest?
Yeah.
The business that grows revenue and profits.
No, which category? Like HVAC, electrical, plumbing, which one is the one that's typically pays back the loan the fastest?
Yeah, I'll probably sound like a broken record here, but I think it all goes back to the operator. I mean, we've had, and also it depends on what the buyer, our customer, the new owner of the business, what their goal is. Is their goal to grow, 2x, 3x revenue and net income in the next 2 to 3 years and then exit to private equity? We've had a few of those where folks have, really scaled and grown and modernized the business and bought the company for, $2 million and sold for $12 million. We've seen that, but we've also seen folks grow and hold. It really just depends on the operator, what their plans are, and what they've been able to do with the business.
Got it.
Yeah, it's not really specific to one, specific industry. I mean, we've had folks in every industry pay us off early, and we've also had a lot of folks that, have really grown, and versus paying us off, they want to use, that excess cash to continue and pursue additional growth opportunities.
Makes sense.
Awesome. Then we'll move here. I know we've talked a little bit about a few of these items, but on the business side, what we start with our review process is previous 3 years of business tax returns, year-to-date profit and loss and balance sheet. If you're an existing business owner, we'll look at your existing business debt that you have to see if there's any ways we might be able to save you money with a refinance opportunity, or just to make sure we're accounting for all your monthly debt obligations for the business in our cash flow analysis. And then again, accounts payable and accounts receivable reports. And then on the personal side, previous 3 years of personal tax returns, we'll look at your personal financial statement, personal credit report, and then we also run a personal bankruptcy search.
Hey, Dylan, can you talk a little bit about refinance options, stuff like that? I am acquiring, right? And so I'm going to have 3 or 4 different loan payments, and it would be great to consolidate my debts, but it doesn't really seem like a great option. You guys
I think our bank and myself, I think we're, brutally honest. We're very transparent. We're not going to try to refinance debt if it's not in your best interest. So, say if someone locked into a rate in 2020, probably not a really good idea to refinance with today's interest rate environment. So we'll just say, hey man, good job securing that loan, great interest rate. I would recommend, holding that as long as you can. But if we do see opportunities, we will say, hey, it looks like your monthly payments are this. I think we can get you to this. Here's the cost associated with the refi. This is kind of what it looks like. Essentially, though, in a nutshell, SBA requires us, we have to save you at least 10% on your monthly payments. So say you have like 3 different, acquisition loans that you want to consolidate into one. As long as we can save you at 10% on your monthly payments, we'd be glad to refi those. And also tying into that with, if you bought companies via seller financing, we cannot refinance the seller note until 24 months of principal and interest payments have been made. So that's, I know that's a way a lot of deals get done in this industry, especially for smaller deals, is, seller note or handshake agreement. We do have the ability to refi those, but again, they have to be in place for 24 months.
So 24 months of the SBA loan or 24 months of the seller finance?
The seller financing.
The seller finance. Okay.
Yeah. SBA, I think we can take out, whenever, as long as we can save you 10% on your monthly payment.
Got it. Okay.
And then with refining an SBA loan with another SBA loan, oftentimes we have to get a letter from your current SBA lender saying they can't match the terms of what we're offering. So, that's another kind of thing that plays into it. But oftentimes it can be difficult to refi SBA debt with SBA debt just because, most time rates are going to be pretty similar. So, kind of hitting that 10% threshold can be a little tricky with that. Awesome, guys. Well, here's my contact info. That's actually my cell phone number and best number to reach me at, and email address. So, happy to help answer, any additional questions on this call.
Yeah.
Or if you guys want to talk offline, shoot me a text, shoot me an email. Happy to talk at any time. To see how we might be able to help you acquire your first business, acquire your seventh business, or if you want to buy that real estate to expand into, or other types of opportunities.
Can you speak a little bit about, like, for each category, like the HVAC, plumbing, and electrical, that the categories that you specialize in? Can you speak to essentially the nuances of each industry in terms of getting the loan? And then what have you seen recently in terms of what are the trends that you're seeing on the files that are coming through?
Yeah. So licensing, I think, is the biggest nuance in each deal. I think we see a lot more HVAC and plumbing deals come across our desk just because there seems to be a lot more of those businesses that aren't tied to new construction and remodel compared to electrical. So I think from a volume perspective, we see a lot of that. I get tons of questions, and I don't, this may be kind of straying off into a different area, but we get tons of questions about multiples, purchase price multiples. Hey, Dylan, can you guys do deals at 2 times earnings? Can you do deals at 6 times earnings? And we close deals for both scenarios. Obviously, if you're buying a business for 5x earnings because you think it's a really good opportunity, from a debt perspective, you'll probably have to come in with some more equity so the debt service coverage shakes out. But multiples have been pretty steady over 2023. I think our average purchase price multiple was about 3.5 times earnings, and our average loan amount was about like 1.5 million. And the average revenue of the business we financed was like 2.2 million. So that's some data that I track, we have on hand. But there's so many. I mean, it really just depends on where you're buying a business. For Tennessee, for example, I don't think there's any state licensing requirements, but there can be city licensing requirements. And then in New York, I believe if you're buying a plumbing company, you have to have the license holder personally guarantee the debt. So there's different requirements for different areas and different industries. So we always want our folks that are coming to us to do that due diligence, and say, hey, Dylan, I'm looking to buy a business in Maryland. Here's the licensing requirements, and then here's kind of my thought process on how I can tackle that. But I think just volume wise, we tend to see more HVAC and plumbing.
Got it. Are you seeing,
I don't know if I answered your question. So.
No, it was a kind of an open-ended question. So that was by design, just to kind of try to understand kind of like the trends, because, if we talked to you 6 months ago, the answer could have been different. So it's always interesting to kind of hear what's out there. And as far as the buy box for the bank, is it getting tighter or is it getting a little bit looser?
That's a great question. So I think in times of economic uncertainty, a lot of banks pull back. When COVID hit in 2020, pretty much every bank was like, I'm only going to do a PPP loan. If you need an acquisition loan or a commercial real estate loan, you're out of luck. With us, specializing in, all these specific industries, we really have a good pulse on the, health of these industries. We have existing portfolios. I think in what we call our service contractor portfolio, which is again, primarily HVAC, plumbing, and electrical, we have like over 100 businesses. So we get to see how those businesses are performing because we collect quarterly tax returns, annual tax returns, quarterly financial statements. So we have a really good pulse on how these industries are doing. So typically when other banks are pulling back, that's really good opportunity for us to keep the foot on the pedal. So, if it's a good deal, it's a good deal. We're going to do it. I don't think, kind of where we're at in the, economy really impacts, our decision on if this is a good business or not. And I think that really plays into us, having a really good feel for new construction exposure, just because the housing market is really tied to interest rates and, can be cyclical. But when, folks are solely focusing on, service repair and change out, that's really not tied to housing economy or interest rates. I think it can have an impact on consumer credit and, homeowners' access to capital. But we typically stay, aggressive and wanting to help get capital in the hands of small business owners.
So of the ones that you have your portfolio, what are some of the scenarios where people have struggled?
So I think personnel is a big challenge in our industry. And I think, if there's any existing business owners here, really depending on any industry you're in can, attest to, it's hard to find good help. And it's such a competitive labor market that you have to pay them really well. And, you have to provide them good benefits, competitive wages, good company culture. So I think personnel is always at the forefront of, if I get all these jobs in, these, opportunities, am I going to be able to fulfill those with, adequate staffing? I think where we've seen some issues with operators, not necessarily in our portfolio, but business owners that I've talked to just from reviewing seller financials, they don't keep up with their pricing for jobs. So, I think from 2020 to 2023, I think there was on average, 8 or 9 price increases on HVAC equipment from distributors and manufacturers. So if you're, paying more for equipment from your suppliers and you're not charging your customers more, that will increase your cost of goods sold, decrease your gross profit margin, which, falls to a smaller bottom line. Yeah. So we've seen a lot of, sellers that want to sell their business, not keep up with price increases and pass that along to the customer, which has kind of, impacted our ability to finance those companies and ability for them to repay debt and overhead. I like to think that, increased pricing from suppliers and manufacturers should be more money in our business owners' pocket, because they should be wanting to maintain a certain gross and net profit margin. So as the average ticket cost goes up, that should be more, net income flowing into the business. Yeah. And I think, business owners have to be smart about how they navigate a sell opportunity when they're in a homeowner's house by offering flexible options like consumer financing and stuff like that.
Yeah, that's huge. A lot of people don't follow. Sometimes they don't even pay attention for those price increases, but they're very consistent across the environment. That's interesting. Chris and I were talking about this recently. We saw this one company. It's a large consolidation of construction materials, and they had it on their website. They had like a section on their website with price increases, and you click on it, it had all the newest letters of like how much they're going to increase it, with an attachment to all their suppliers sending them letters of price increases. And I thought it was amazing. It's like right there on the website.
Guys, I can't do anything. My hands are tied, Yeah. But, and kind of to add to that, I think seller due diligence is always going to be really important. If sellers misrepresent the financials or the culture of their company, that can be detrimental in a transition of ownership. If you're buying a company with a toxic culture, I don't think new ownership is going to help that, with the existing employees. Also making sure you're looking into, specific like labor and employee, laws and your certain states. There are certain states that require folks be required to take a lunch break after a certain amount of hours. And if they don't, you have to pay them a certain additional wage. And if not, they can come at you for litigation. So I think as the due diligence, buyers have a ton on their plate. And I don't think company culture and employees of the selling business should ever be overlooked. Also kind of figuring out does that seller of that business spend 8 months out of the year in Florida playing golf, or are they out running service calls and closing jobs? And what involvement do you want to have as a new owner? So I think all those are really important.
What have you found on the culture piece? What have you found that ways or strategies to kind of understand what that culture is? Because a lot of times the seller is not allowing the new buyer to talk to the employees or the techs. So what have you found as a way that buyers have were able to due diligence the culture?
Yeah, I mean, online creeping, I guess, is a simple way to say it. I mean, looking at Google reviews, I think if a business, has a lot of recent, solid and stable Google, high star Google reviews, then that should speak to, the folks within the company. Ideally, it's great when you can meet with like the key employees of the company that, will want to be staying on post closed. Oftentimes, that may not be an opportunity. But I guess just trying to get a feel as much as you can through reviews and, just due diligence on, how that company operates. It can be tough, and that can be one of the challenges, especially if the seller wants to stay closed off. And I always tell folks to trust their gut. If you got a bad feeling about the deal, probably not a good idea to move forward. I think there's always risk that are going to be in these deals. But trust your gut as a business owner. I mean, if you're in the opportunity in the position to buy a business, you've been able to get along that far for a reason. And, just trusting your gut and judgment, I think is really important. And don't just do it because the numbers make sense.
Yeah, we always talk about this. If you don't like the seller, you're not gonna like his people.
Yeah.
So it's just like if he gives you the a certain vibe or a certain attitude, most likely that's gonna trickle down to his supervisors, managers, and to his techs.
That's a really good point, Jay. I like that.
Do you, in terms of financial due diligence, what are some of the things that you've seen that people kind of miss, or things that kind of end up getting caught later that are specific to HVAC, electrical and plumbing?
I think, a lot of financial due diligence in these businesses is sifting through a ton of add backs, personal expenses that sellers are running through the business, and just making sure that those are all verifiable. Never add back cash jobs to the profits of a company. I know a lot of brokers and sellers try to do that. So, that's something that we can't do, and a lot of other banks can't do. If there's, government subsidy funding, always make a negative adjustment for that. So if they received a PPP loan, don't include that in the revenue and profits, or an EIDL loan, or employee retention tax credit. Always back those out. If they've sold, 7 trucks in a year and they're showing that as other income, that's probably not, going to be reoccurring income. So make an adjustment for that. And really, customer concentration, work mix, I can't harp on that enough, is really important for us. And then also, if you see that revenue is, we see a ton of businesses where revenue has been flat 2020, 2021, 2022, They decide they want to sell in 2022, so they start reporting everything correctly in 2023, and you see a huge spike in revenue and earnings, and ask tons of questions on hey, like, what happened here? Is this sustainable? I already know my bank is going to ask me tons of questions. So really, like, looking at trends with revenue and margins, KPIs. I think is pretty important in due diligence, and also don't overlook payables and receivable reports. If business is struggling with accounts receivable, that's going to be tough to manage cash flow cycles. And then if they're not paying their suppliers, then you could be buying a business that doesn't have a good relationship with those suppliers, which you come in at an awkward stage as a new owner. So I think all those are really important to spend time on.
How do you think through the equipment?
In terms of
like the trucks, equipment, and all that stuff, is that something that you get, aside from accounting for it and just trying to understand the value, is there anything else that you think about when you think of equipment?
I mean, some folks like to purchase a lot of inventory and keep that on hand. If they, had bad distributor relationships in the past or supply chain issues in the past, some have great, experiences where they get their equipment delivered for their jobs, the night before. But really just, I think the payables and receivables reports kind of, the proof's in the pudding there. But we're fine either way if a business owner likes to keep inventory on hand, equipment on hand, or if they like to just kind of stock up as needed. Got
it. Interesting. And is there a big difference in terms of like the types of lines that these operators have with their suppliers? Is there like a big gap that some of them have like a larger line of credit with that supplier, or a larger ability to to pay at a longer? Yeah. Do you see a big gap in those, or they're very similar?
You'll typically see larger businesses have larger lines and the more ability to float payments to their distributors, just because they're buying so much equipment from that distributor, and that's a way for distributors to leverage relationships. But I work with a lot of distributors in the industry, and that's not something they really like to do. So we also offer lines of credit that kind of help take the burden off the distributor and help that be a solution for our business owner. But typically, the larger the business, the larger the lines you'll see.
Got it. And do you count that as part of your net working capital calculation, or no?
Yeah, we look at cash flow cycles and all that. And, a lot of it is the size of the business too, which determines how much, working capital or a line of credit we can include. And
in terms of that cash flow cycle, is there like a difference between regions or different specialties that some of them have a much better cash flow cycle than others?
Yeah, residential seems to have a better cash flow cycle than commercial. Commercial, you're usually on net 30, maybe net 60 payment terms with the jobs you're completing. So you'll typically see a need for a larger line of credit with those businesses. Residential, you're typically getting paid at the time of service. And then also, like with new construction companies, the receivables and payables amounts are a lot higher on those types of businesses. But it doesn't really differ from HVAC to plumbing or electrical. It just depends on residential versus commercial.
Okay, not even like regionally. There's no difference really. Got it. So that means you prefer residential over commercial?
We like commercial too. It just depends on exposure to new construction, customer concentration risk. If there's, if they're floating 30-day payment terms with their customers or 60-day payment terms, we just want to make sure, that that's stable and they are getting paid.
Yeah.
And not having to chase down payments too much. So those are things.
What are some of the creative ways so what are some of the issues that you see that end up happening in negotiation with the sellers? And I mean, net working capital is one. It's always an issue that pops at the end. Seller financing terms are always an issue that pops at the end. Is there any other issues that you've seen, during the deal process?
First one's closing date. Sellers always want their money yesterday.
Yeah.
And that's what gives us, ability to win a lot of businesses, the ability for us to approve and close loans in a timely manner. again, with us being the #1 SBA lender, we're a preferred lender with the SBA, so we get to approve and disperse funds in-house versus going to them for decisioning on PLP loans. So speed and closing date, I think, is one of the main things that is always discussed. Seller notes are also a big one. A lot of buyers like to tie, a lot of forgivable seller notes to certain financial metrics, which is good. I think finalizing a purchase agreement is one of the more time consuming and more negotiated items that we typically see in these deals.
Yeah. And so aside from the seller financing, net working capital, I'm assuming there's some conversation around non-compete, non-solicit.
Yeah, we typically see like a 5-year, 50-mile non-compete. I mean, pretty standard.
Typical. Okay.
I mean, each deal is so different.
Yeah.
There's, making sure our buyer has, equity lined up if that's required, sourcing that's, important. But really, I think a lot of it, like you said previously, a lot of it goes into the relationship between the buyer and seller. If there's a good relationship there, they can typically work through a lot of things that can be kind of burdensome if you don't have a good relationship with the seller. Having a good broker is also obviously important if there is one involved in the deal. But closing date is typically like the question I get asked the most from our closers, when they're talking to customers.
So in that forgivable seller note point, what are some of the structures or the common structures that you've seen acceptable within HVAC and plumbing?
They're usually tied to revenue. They're mainly tied to revenue or employee retention.
Okay.
The one thing that SBA does not allow is like earnouts or seller notes that have upside for the seller. So like, purchase price will exceed by X amount if, you grow 30% in revenue or sales.
Yeah.
That's something we can't allow for, but, if revenue doesn't hit, say for example, revenue doesn't hit, what the average was for the past 3 years, then, this seller note will dissolve or decrease by X amount. I mean, it's really, up to the buyer to see what the seller can get comfortable with. But typically we see it most of the time tied to revenue.
Revenue. Okay.
Yeah. Cause it's kind of hard to tie a seller note to profits just because, a seller doesn't know what kind of, investments the new operator is going to make, which can increase overhead and lower net profits. So it's simply tied to revenue.
So maintain a certain average revenue over 1 year, over like a couple of years.
Again, that was just a random example. We see all different kinds, but I would say, just it's typically tied to revenue and it's at the buyer and seller's discretion.
Got it. Okay. And in terms of net working capital, what have you seen in terms of like challenges in terms of like coming to an agreement of what working capital is, or in your situation, because of that average is small, you just assume that you're not getting any working capital from the seller.
That's what we assume. And we just want to make sure we're, every deal, we want to make sure we're properly capitalizing our business owners to help with payroll on the first week or, equipment purchasing on the first week. We want to make sure that they have cash in the bank until, the business is able to really transition and continue producing revenue. Last thing we want to do is have a new buyer buy a business and be strapped for cash in week 2 after closing.
Got it. So what are some of the things that the good buyers do to have a good closing?
I think due diligence, and kind of trying to be one step ahead is really important. The 2 items that seem to drag out closing the longest are there's a life insurance requirement and then finalizing a purchase agreement. Those are typically, always the 2 items, but I think just taking accountability and responsibility that this closing checklist that we send out, while we're there to help you every step of the way and answer every single question, a lot of the action items you have to do. We understand that oftentimes you're running an existing business or operating your job that you're going to leave, and the time's hard, but just being on top of it and don't be afraid to ask questions. Again,
any quality of earning services that you like, that you've worked with in the past within HVAC or and plumbing? Some
We
guys that
don't-
specialize in the space.
we don't have specific like requirements around Q of E's for
Yeah.
SBA loans. I think they can be required for our middle market and conventional loans.
Sure.
But we do have some resources if you want to reach out.
Yeah.
We have, some folks that I contact info I can pass on for Q of E. And then also we do know some really good industry specific brokers in the space as well that we could point you to.
Yeah,
So,
that'd be great. Okay.
yeah. So feel free to reach out
I'll send you an
offline
email.
and
Yeah.
I'll be able to help put you in
I
contact.
appreciate it. Cool. Well, thank you, Dylan. I appreciate you taking the time today. I think this was very helpful.
Yeah.
Get to know you, to know the bank, and hearing about what you guys do. Thank
Yeah.
you.
Thanks, Jay. Appreciate all the great questions, and hope you guys have a good afternoon.
I appreciate it. Thank you.
Yeah. Take care, guys.